Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." Compounding not only applies to rates of return that we can experience in our portfolios, it also applies to other rates, like the rate of inflation. The latest inflation report showed an overall increase in the Consumer Price Index, or CPI, of 8.6% compared to 1 year ago. Rising food, energy, and shelter prices may already be dinner table conversations by now. This level of inflation has not been seen since December of 1981. Over the past 50 years, inflation has averaged about 3.95%, or nearly 4% per year. Now, we expect these higher current inflation levels to continue putting pressures and changes on consumer spending patterns. Now, let's talk about inflation and retirement planning. Today's discussion applies to individuals that are in or close to retirement more than those still earning income from a job. So, how do we invest to keep pace or defend against inflation over time? First, let's look at historical inflation. Over the past 50 years, inflation has ranged from nearly 15% in 1980 to around 0% per year, and even negative for a short time in 2008 and 9. Next, we relate Einstein's comment on compounding returns and the impact of inflation. The implications of inflation are evident in the short term and talked about around the dinner table. However, mathematically, the impact of inflation is more significant over the long term. Let's walk through an example. A hypothetical retiree with $2.5 million in retirement savings. They are withdrawing and spending $100,000 annually. If inflation were 0% per year, we'd know that over the next 3 years, they will consume $300,000, or 12% of the retirement savings. If inflation were at 10% per year, they would consume $331,000 to maintain the same purchasing power, which ends up being about 13% of their retirement savings over that time period. Now, the difference of $31,000 is spread over 3 years. It is discernible, however, relatively small on their $2.5 million overall portfolio. Recall that the average inflation rate has been about 4% per year over the past 50 years. Also, during this time, the stock market generated an annualized return of 10.75% per year. Cash pretty much hung in there with inflation over this time period. However, the stock market broadly was the main growth engine. It kept pace with inflation and generated returns that could be applied for future spending needs. So why not just put an entire portfolio into the stock market? At Vector, we use a bucket-based investing approach. The short term is uncertain and larger price swings in the stock market do occur, as we are seeing today. Portfolios that are appropriately diversified across time and asset class types, we believe, can effectively accomplish the objectives of meeting short-term income needs and outpacing inflation over the long term. Okay, so let's summarize this topic. The effect of compounding on rates of return and rates of inflation are more impactful over the longer time periods. Cash and other more stable investments are suitable for fulfilling short-term income needs. However, it's unlikely these will keep pace with inflation. Stocks and other assets with more limited supply are uncertain in the short term. However, they have historically outpaced inflation and provided growth opportunities in the long term.